Welcome to the deep dive. Today we are taking a focused look, a deep dive into a relatively new exchange-traded fund. It trades under the ticker BRKC.
Yes, that's the YieldMax BRK.B Option Income Strategy ETF. And for this dive, we're working from several pieces of information: the fund's overview, a press release, parts of the summary prospectus, and also a transcript discussing the fund.
Right, and our goal here is pretty straightforward. We want to pull out the key information from these sources. We need to understand this fund's strategy, what it aims to achieve in terms of income, and very importantly, the risks involved.
Especially important for you, the retail investor, who might be looking at this type of income-focused investment.
Exactly. And it seems crucial, based on the materials, to stress one point right at the start.
Which is?
While the fund uses options linked to Berkshire Hathaway Class B shares, BRK.B, it doesn't actually own those shares directly.
Correct. That's fundamental. The strategy generates income related to BRK.B, but it's an indirect exposure. Understanding that difference is, well, key to understanding everything else about it.
Okay, a significant distinction. So let's start with the fund's stated goals. What are the primary and secondary objectives laid out in the sources?
The sources state the primary objective very clearly: to seek current income.
Simple enough. And secondary.
The secondary objective is to seek exposure to the share price of BRK.B. But, and this is a big but, from the sources, that exposure comes with a limit on potential gains.
So you get some link to BRK.B's performance, but your potential profit on the upside is capped.
Precisely.
All right, so how does it try to achieve this income and limited exposure without holding the stock? What's the core strategy?
It's an actively managed strategy. The main engine for income is selling or writing call options that reference BRK.B.
Okay, and the sources describe this using the term synthetic covered call strategy.
That's right. Since they don't own the stock to cover the calls they sell, they create a synthetic position that behaves similarly to owning the stock.
How do they build that synthetic position?
It involves two parts run simultaneously. They buy BRK.B call options, and at the same time, they sell BRK.B put options.
Buying calls and selling puts?
Yes. The sources mention these options usually have terms of about 1 to 6 months, and the strike prices are typically close to where BRK.B is trading at that moment. The idea is that this combination should roughly track BRK.B's price movements.
Okay, so they've engineered this synthetic equivalent of holding the stock. Then they sell calls against that.
Exactly. That's the covered call piece. They sell call options on BRK.B against this synthetic long position they've created. These sold calls, according to the sources, tend to have shorter expirations, like a month or less.
And where are the strike prices set for those sold calls?
The sources say typically somewhere between 0% and 15% above the current BRK.B share price, and the income the fund generates comes primarily from the premiums they collect for selling these calls.
Got it. The materials also mention U.S. Treasuries being held. How do they fit in?
Right. Short-term U.S. Treasuries are held mainly as collateral for the options positions. They need assets to back the options they've written or bought.
And they provide some income, too, presumably.
They do, yes. That Treasury income contributes to the overall income goal. The sources actually give a range, suggesting cash and Treasuries might make up between 50% and 100% of the fund's net assets. The options exposure would be the rest, so 0% to 50%.
Now, the sources also bring up an alternative tactic that the advisor might use something called a synthetic covered call spread. How is that different?
It's a variation they can choose, perhaps if they think BRK.B might have a strong rally in the short term. Instead of just selling one call option,
Yes.
they sell a call option, but they also buy another call option simultaneously. This second call has a higher strike price, but the same expiration date as the one they sold.
So selling a call and buying a higher strike call, what's the point of adding that bought call?
The idea is to potentially capture more upside if BRK.B really takes off. If the stock price goes above the strike of the call they sold, owning that higher strike call offers some participation in those further gains, unlike a standard covered call, which is strictly capped.
I see. But there must be a trade-off.
There is. Buying that higher strike call costs money, so it reduces the net premium income you receive compared to just selling the call on its own. It's a balanced, potentially less immediate income for a chance at more participation in a rally.
Okay, so putting it together, the distributions the fund aims to pay out come mainly from these options premiums, either from the straight calls or the spreads and the interest from the treasuries.
That's the picture painted by the sources, yes. And they aim to make these distributions monthly. The first one, according to the press release, was anticipated around July 9th, 2025.
Are these monthly payments guaranteed? or consistent?
Oh, definitely not guaranteed. The sources are very clear on that, and the amounts are expected to vary quite a bit month to month.
Right, and they maintain this exposure by rolling the options.
Yes, as options get close to expiring, they'll typically close those positions and open new ones with later expiration dates to maintain the strategy.
This whole structure sounds quite different from just buying and holding BRKB shares. How should an investor think about the returns here versus direct stock ownership?
Very different profile. Because they're selling those call options, the fund's potential gains are capped if BRKB shares rise significantly. You don't capture all the upside.
Okay, capped gains. What about the downside if BRKB falls?
The sources state the fund is subject to basically all the potential losses if BRKB shares go down. The income from the options and treasuries might cushion the fall somewhat.
But it might not be enough.
It might not be enough to offset the losses from the synthetic BRKB position. So income generation is the goal, but it doesn't eliminate the risk of losing capital if the underlying reference asset declines.
And if Berkshire Hathaway itself pays a dividend on its stock, do BRKC holders get that?
No, the sources confirm that. Since the fund doesn't hold the actual BRKB shares, shareholders in BRKC don't receive those dividends.
Let's talk more about the distributions themselves. The sources mention something specific about their potential makeup.
Yes, this is quite important. While distributions might include some ordinary dividends or capital gains from the strategy, the sources specifically flag the possibility that a significant chunk could be classified as return of capital, or ROC.
Return as capital.
They even reference that this has been seen in distributions from other YieldMax ETFs. And ROC is basically the fund giving you back some of your own invested money, not necessarily profits it earned.
And what's the implication of that?
Well, the sources are direct here. Distributions that include ROC reduce the fund's net asset value, its NAV, and can therefore lower its trading price over time. If this happens repeatedly, especially with large ROC components, it can erode your initial investment. You might see high distributions, but your actual principal could be shrinking.
That's a critical point. High yield doesn't always mean high total return if the NAV is eroding. Did the sources give any current yield figures?
They did, but with very strong caveats. As of early June 2025, the distribution rate, which is based on the most recent payout annualized and includes option income, was listed at 0.00%. Zero. And similarly, the 30-day SEC yield, which is a standardized calculation based only on things like interest and dividends, so it excludes option income, was also 0.00% as of the end of 2024.
Why so low or zero?
The sources heavily imply this is just because the fund literally just launched June 4th, 2025. There simply hasn't been enough time for it to generate and distribute significant income yet. The key takeaway from the sources is don't rely on these initial zero figures. Future distributions aren't guaranteed and will likely vary greatly.
Understood. Okay, let's shift gears to costs and the rather long list of risks detailed in the materials. First off, the expense ratio.
The gross expense ratio is listed as 0.99%.
Nearly 1%. And the risks, the sources really emphasize a high degree of risk, potential loss of investment.
Absolutely. That's the headline warning. Then they list specifics. We should probably touch on them, even if quickly, as they're all mentioned in the sources.
Agreed. So there's BRKB risk. Even without owning the shares, the fund is tied to its performance and risks.
And relatedly, diversified financial services industry risk, because that's BRKB's main sector.
Makes sense. Then, obviously, derivatives risk. Huge category covering market risk, volatility, liquidity, counterparty risk for options.
Imperfect correlation, valuation challenges, all sorts of things related to using options. There's also specific options, contracts, risk options expiring worthless, costs of rolling them over constantly.
And counterparty risk, again, specifically for the clearinghouse involved with the options.
Then there's the risk we discussed. Price participation risk,
Yeah.
capped gains, full downside.
Distribution risk is listed not guaranteed, variable amounts, and potentially including that return of capital.
Which leads directly to NAV erosion risk due to distributions. The sources explicitly warn that distributions can lower the NAV and share price.
There are also call strategy risks, mentioning things like path dependency, meaning how the price gets somewhere matters, and the specific risks of the call spread variation, like lower premium income.
And then a whole suite of ETF risks. Things like authorized participants market makers concentration risk,
Potentially causing trading at a discount or premium to NAV.
cash redemption risk, possibly triggering taxable gains within the fund, Costs of buying, selling shares like brokerage fees and the bid-ask spread you pay.
Management risk, because it's actively managed and might not succeed, shares may trade at prices other than NAV, that premium discount risk again.
And trading risk like low volume, trading halts, market closures.
Because of the constant options trading, there's high portfolio turnover risk.
Which means potentially higher costs and more short-term capital gains taxes for investors.
Then broader risks, inflation risk eroding value.
Liquidity risk, especially for options on a single stock if the market gets choppy.
Market events, risk from general economic or geopolitical issues.
Money market instrument risk for the collateral.
Stooth fund risk, no track record to judge.
And critically, non-diversification risk and single issuer risk. Focusing solely on BRK.B makes it much more volatile than a diversified fund.
Almost there. Operational risk, human error, system failures.
Tax risk, including the fund potentially not qualifying as a RIC, plus the tax implications of distributions for you.
And finally, U.S. government and U.S. agency obligations, risk related to the creditworthiness of the collateral held.
Phew. Yes, it's quite a list, detailed in the sources.
It really underscores the high degree of risk warning. And the sources also repeat the standard disclaimer. Past performance doesn't predict future results, and short-term results aren't indicative. Given the June 2025 launch, there really isn't performance data anyway.
Right. So understanding the strategy and these documented risks is paramount, as there's no history to look at.
Okay, so let's try to wrap this up. Based on our deep dive into the source material on the YieldMax BRK.B option income strategy ETF, BRKC Coal, it aims for income by selling options linked to BRK.B stock it doesn't own.
Correct. Using that synthetic approach, offering capped upside potential in BRK.B, but retaining the full downside risk minus whatever income is generated. It's a complex option strategy, quite distinct from just owning Berkshire Hathaway.
And while income is the goal, the sources make it abundantly clear it comes with numerous significant risks.
Yes, risks tied to derivatives, the non-diversified focus on BRK.B, the very real potential for NAV erosion from distributions, especially if they include return of capital, and that whole long list of other specific risks we just covered.
So maybe the final thought for you, the listener, particularly if you're seeking income, is this. You're presented with a strategy aiming for yield, using synthetic exposure to a single, albeit large, company like BRK.B. Gains are capped. How do you weigh that potential income stream against the very detailed risks laid out in the fund's own documents, especially the risk of your capital declining, the NAV eroding, when deciding if this fits into your diversified income portfolio?
That tension between the potential yield and the complex risk profile seems to be the central question emerging from these materials.
Thank you for bringing these sources to us for this deep dive.
And remember, this discussion was based entirely on the information within those provided documents.
Absolutely. We strongly encourage you to read the full prospectus and all related disclosures yourself for complete information before making any investment decisions.
Definitely. This deep dive is purely for informational purposes based on the sources provided. It is not and should not be taken as financial advice.